Welcome back to another episode of the Anatomy of the Trade. Today is a very unique session. We're going to discuss some hedging techniques, and those are going to be related to the trade in metals that France is currently in. And we're going to see how he was going through this most recent correction that started in August and lasted into the end of November. So with that, France, please tell us, and this is GDXJ, what was the rationale for having a hedge?
This, thanks, Ramon. Yeah, this is one of the, this is an ETF that purchases junior gold mining stocks. And the chart that we're looking at here is just the end of a powerful rally that started back in, I'm trying to remember, I think it was about May, where there was a very long trading range that was formed, and there was a breakout. And so we're seeing the end of this initial kind of sign of strength rally. And it looked to me, being in this, that we had a definite, kind of first point of excitement, climactic move, buying climax, and where I've got the automatic reaction marked on the chart, it looked like the up move was done, and we were definitely experiencing a change in behavior and getting ready to go into a trading range. So this position and these precious metals positions that I've got, this isn't the only ETF that I've got in this area. I'm trying to campaign them, but I don't want to go through a correction, a trading range with the volatility, and kind of suffer some, at least short-term, heat and pain and so on and so forth. So I decided, well, what I'm going to attempt to hedge this, and I'm going to use an inverse ETF that goes the opposite direction. Now this inverse is JDST, and it actually moves double what the underlying GDXJ does in the opposite direction. So I only had to buy half of this JDST to hedge my GDXJ long position. So you can see on that first secondary test of GDXJ, I decided, okay, I'm going to hedge 60% of my long position. So at that point, I purchased enough JDST to put on a 50% hedge. And after that test, when we weren't able to make additional upside progress, we came back down into the support, into the automatic reaction area, and kind of established some support. I felt pretty good that this was going to be a trading range. So I'm thinking, okay, well, the next time we try to go up to resistance, I'm going to add to my hedge position. And you can see I did there. I was a little bit premature, but I got pretty close on that first, and then the second one, I added some more. And just because the underlying, if you look at what the supply was somewhat elevated throughout this area. I mean, we were seeing there was definitely selling going on in the GDXJ. So I'm thinking, okay, well, I'm going to add some more. I was 90% hedged. There was a significant sell-off. It actually went below the support level. Did attempt to spring, but even the spring attempt wasn't really all that strong. So at that point, I decided, okay, what I'm going to do is I'm going to sell a little bit of the underlying, 10% of the underlying, to bring my hedge position to 100%. So at this point, I'm fully hedged. I'm going across the trading range. One of the things that I noticed, and people that use these leverage that I'm sure are familiar with this, is that there's decay, there's time decay because of how the leverage vehicle is structured. So, but at any rate, went through another swing, and there was a very weak rally attempt where it says PO exit on November 16th. I actually sold half of my total underlying position and sold the hedges to offset that. That would be in November. And there was a sign of weakness. And at that point, at the end of November, it felt like, and the kind of the selling was not totally, I mean, just looking at that whole downtrend, that last swing, other than that last bar, there wasn't that much supply, and I just thought, well, this looks like a place where we could rally, pretty nicely. So I took the hedges off at that point, and then maybe I'm pressing it a little bit on that first rally and a little bit of pullback. I actually went long the 2x bull. So at this point, I'm not only not hedged, I'm actually long, expecting a potential further rally, and I could be wrong. And if I am, I'll just close the JNUG position and go and hedge again. But anyway, that's the story.
Yeah, well, I think it's a really great trade because the intention was to hedge against the much larger position. You're using the vehicle where you don't have to match the financial commitment, so you can buy less and yet still cover and have the whole move hedged. So, I mean, and it lasts for a while. There are quite a lot of emotional spots where you could get out of the main position. So, for instance, here, 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 all of those points where the price kind of breaks down or tries to break down, and the volume signature increases, the spread to the downside increases. Those are the emotional spots where it is so easy to get out of the position, and that would be an incorrect decision if your companion gold, companion silver, or miners. So I think this is just a brilliant strategy that allowed you to stay in the main position, and also your equity curve obviously stabilized, and it wasn't just going down. And especially in your case, France, and I know that majority of your portfolio holdings are in metals, gold, like those miners and so on and so forth. So you kind of overexposed in your portfolio to just like one theme, and it just definitely makes sense to hedge. Um, as you mentioned, there is a problem with hedging, with those inverse double, triple ETFs, and that is that there is some kind of, recalculating that they're doing, and this is the actual hedging instrument, recalculating that they're doing that, as you said, it's up kind of like there is some almost like a time decay built into this. So not the most efficient vehicles to do that. So now let's just go into kind of like the technicalities here. So we're thinking that from here, right? So this is a change of behavior. And this change of behavior just basically tells us what? It tells us that we are going to be in the change environment from the downtrend. And we're looking, because this is inverse, so bear 2 2x. So we're just looking at the chart reversed.
Mhm.
Change of behavior, suggesting a trading range. So I started thinking, how would I go about this? I probably, knowing that we are in the trading range, I would be thinking about oscillations.
Mhm.
So oscillating trades around support and the resistance. And you have a capacity to actually recognize the prices at the lower and at the upper level. I mean, just like judging by some of your entries and your exits. So I would be probably thinking, get in here, secondary test. What's the next point where, I could be getting out? Well, probably somewhere where the selling has started, somewhere here. So, and just get out. Do not
Yeah.
go through this whole thing. Then put one on, put the second on, get out on this bar where, you have supply coming in. And
Yeah.
then do it again, somewhere here, somewhere here. So
Yeah.
um, somewhere here, somewhere here. And because you have the underlying position on, the hedge is kind of comes easier because you just basically almost freezes your equity curve depending on the balance that you have between the underlying position and the hedge. So it could be maybe like 100 to like 80% or 100 to 90%. So it's not going to be like extremely balanced, and it doesn't have to be, but if the majority is hedged, then it's just like great. So that's the thought, that's the only thought that came to me in terms of how possibly, I would be thinking about this problem. But I would say this is just uh, a very, very great hedge that you had, and especially the final exit right here. If we would be thinking like, okay, well, yeah, we needed to hedge through the whole period of this correction, and this correction in gold has been somewhat challenging. Again, there were quite a lot of spots where you could emotionally get out. So from that perspective, I think this is a really nice hedge, and it just gives you like a clear mind as to what to do and when to add to the underlying position, when to get the hedge out. So kudos to you, Franz. Let's go through the post analysis, and I don't even know how we're going to do this, so let's just try. So buys, definitely yes, right? Because you were betting on the price having a correction, so that's absolutely correct. I think timing is absolutely great. So you are buying this hedge at the support here. Character, expecting a reaction, yes. Points of entry, yes. Stop losses, I would say yes, right?
Yeah, but it's really not applicable because
Yeah, there's. Mhm. But
it's just
still,
offsetting something
you're
else.
probably thinking here, what if it goes below this level, right?
Yeah, yeah. If suddenly GDXJ, which I'm hedging, emerges from the trading range that it's in with an obvious directional bias, then yeah, I'm going to have to take this off. So
Okay,
I
so
was more
I
looking
think
at.
that this is an unspoken stop loss right here. So let's just put
Okay,
yes. Add-ons definitely yes. Exit yes. So 100%. Is this the first trade like this?
this is not possible, Roman.
Well, I mean, that's factual.
Yeah, and actually, after doing this, um, I think what you were pointing out in an even better way to manage this is, especially with the decay, is to use this just and trade the swings, which is what you're basically suggesting to do. Get
Okay.
in.
Well, I mean, okay, let's put this in the comments, right? So, uh, trade it as swings. So, I would say yes and no. And even though, we've talked about this, I think it's actually worked out very nicely. Um, just considering the structure of the underline was a little bit different because the structure, like for instance, of gold was this, right? Something like this. So it was downsloping.
Yep.
We have a little bit of the upslope here, but not as much as in gold itself
Right.
to the downside. So we're
Yeah.
seeing that, decaying
Yep.
qualities of this instrument.
Yeah.
So therefore, I think if you're precise on your entries and still precise on your exit, but you're going through this whole reaction in gold, and I think that's what's nice about this hedge. It's maybe not about like being extremely precise or being like short-term oriented and taking the profits, but just stabilizing your equity for the duration of the reaction to allow yourself to hold on to the underlying position.
Right.
And I think that's what was so brilliant about this. Having said this, on the yes part, yes, you could have um, done, smaller trades and then don't go through the reactions, which were three of them. So that was probably very hard to do, just to see that. But at the same time, as the price here goes down on your hedge, your underlying is actually performing well. So you're still
Right.
in that emotionally great space.
Right.
So I don't know what else to add. I mean, to me, this looks like a very perfect hedge and just a just a very brilliant strategy.
Well, thank you.
All right. Well, was this this was kind of very unique, guys. This is something that definitely we're going to be developing more in the practicum class in the next semester. So, Franz, we should bring this example and just do the case study on this during the WTC2.
Cool. Let's do it.
Yeah. All right. Well, with that, thank you so much for watching, and we'll see you next week.